Hello and welcome to UTI Mutual Fund presents the Swatantra series powered by ET Now. This is an investor education initiative that will help you work through the basics of investing and begin investing your money. Today we're going to focus on young investors. We have a studio full of young investors who've come in to ask their questions, and we have two wonderful panelists who joined us in the studio. I'm going to do a quick round of introductions. Karan Singh is the Senior Executive Vice President and Country Head, Banks and National Distributors at UTI Mutual Fund AMC. Feroz Aziz is the Executive Director, Investment Products at Anand Rathi Private Wealth Management. Gentlemen, thank you so much for coming in. I'm going to just get the ball rolling because I want to ask both of you this. Karan, let's start with you. When I'm just starting off and I'm making my first salary, the tendency normally is to spend it because right now we live in a world of consumerism where there are so many things I can spend my money on, technology not being the least of them and so expensive. How important is it for me as an investor to start off as early as possible?
Well, I think this is a great opportunity for me to share with you, because had this kind of a session happened when I was just passed out of college, I would have been much, I would have been prospering much more. But I think this is a great time to share with all of you, because if you start early, I think your money would grow. You invest through discipline. They should not be carried away by the volatility in the market. SIP is the first way you can start investing. And if you have short-term goals, you need to first of all identify your goals. What are your financial goals? Prioritize your goals. Set up a time horizon for your goals, and then accordingly decide. And when I say this, if you're looking at something you need in 3 to 6 months, you should start with, SIP in a liquid plus kind of schemes. If you have another 6 to 12 months kind of a horizon, then you should look at short-term income fund or short-term bond fund. And then if you have a slightly further horizon of 1 to 2 years, you should look at SIP in dynamic bond fund. So once you have exposure in the funds that are, that preserve your capital and generate some income for you, then you should look forward to, move forward towards long-term investment in equities and, other products.
Feroz, if I were to ask you to give advice to a first-time investor, especially a young investor, and normally the tendency is to try and make as much money as possible because I'm aggressive and I'm young, what advice would that be?
See, firstly, I think the young investor has one thing on his favor, which is his age. Like Karan was just mentioning, start early. See, what happens is, like Faye just mentioned, that if you are actually a person who has just started working, you're very keen to spend, right? Because you've always been brought up in an environment where you've got a smaller pocket money, your expenses have always superseded your pocket monies, most often than not, right? So what happens is, you end up trying to spend most of the money. But one thing which we forget, today we are in a very, very good tax regime. We end up maximum tax the government collects is 33%. In this country, the tax has been as high as 90%. So you should immediately think that the tax is not 30 and there's another investment tax of 20-25% on your salary. Right? So we are lucky to live in a regime where the taxation has come down from greater than 90 to 30%. So assume that the tax is 50 and make sure that investment becomes an integral part of your salary. So that's one thing which is very critical when you're actually getting lured to spend your money. So that's what I would say. So to answer Faye's question, what would be my first piece of advice? Don't waste a day or a month. Start today and start small, because you will learn easily if you start small, and that doesn't matter if you went wrong as well if you started small.
Actually, even before that, we have a checklist of things for young people to do when you're just starting off. The first of which is to create an emergency fund, because you rely on your salary month on month. So 3 months worth of expenses have to be in a bank account in case your salary doesn't come in on a particular month. You have to have health insurance. You can have life insurance only if you really need it, but health insurance is a must, because you don't want to break into your mutual fund if you have a health emergency. So have health insurance, have the emergency fund, then start investing at 500 rupees a month, which is the basic that you can put into a mutual fund, and start to find your feet. You'll become more confident slowly, and then you can start to invest in more strategic things. Karan, tell me this, it is a tough market out there for a new investor, because we have hundreds of mutual funds that are from different companies that do different things. if I'm new and I'm starting off, how do I choose a mutual fund? How do I decide that, okay, in the equity mutual fund universe, this is the focus I should have and this is the fund I should be using?
Well, I think first step would be you need to choose your investment advisor. And once you choose your investment advisor, the next step would be to look at your risk tolerance and your investment objective. Now, when you segregate that, and you must keep your retirement planning in mind, because that's the foremost thing you need to do when you start investing. And retirement planning can happen through various stages, right from, the first stage could be the accumulation, wherein you see, since you are young, you can commit mistakes, you can get into equities, equity mutual funds and gold, ETF, and so on and so forth. Once you reach a certain corpus after a few years, and then you should look at how to preserve your capital and get regular income out of that. So there are various schemes like systematic withdrawal plan or other dividend options payout, which gives you a regular stream once you retire. So I think it's a huge, long process wherein you start early, you get into accumulation stage by investing in various products which matches with your risk profiling, and then when gradually you are reaching your retirement stage, you can look at preserving your capital and getting a regular income out of that.
All right, I'm going to take one question before we go into break. You, the gentleman in front, you had a question. Go ahead.
Sir, I want to ask one question. As a young investor, I don't have much knowledge about the mutual fund and all these things. How to choose a good mutual fund, or it's better to go into the fixed deposit in the bank account?
If you invest in, so both of them are typically for a customer with a moderate risk or no risk profiling. And if you compare it with the debt fund, fixed income funds and mutual fund, and if you hold on for 3 years, it will give you a post-tax better return than a fixed deposit. So if you have to hold on for 3 years investment, and when you look at your post-tax returns, it will be better than a fixed deposit return.
In fact, we have to go into break, but when we come back, we'll talk about what inflation can do with your money. I know Feroz has a story to share with us. That's after the break. Like I said, there's a website on your screen right now and a Twitter handle, so you can get in touch with us if you need to. Come back after the break and we'll talk about what inflation does to your money. Don't go anywhere. Welcome back. You're watching the Swatantra series on ET Now. Thank you so much for staying with us. Before we went into break, we were talking to young investors about starting early and investing their money in a smart and efficient manner. Just before we went into break, Feroz, we were talking about inflation, and the question raised by one of the young people in our audience was using a fixed deposit vis-a-vis investing in mutual funds or investing in equity. And the thing we don't consider is a lot of people say, oh, I'll get 9% from a fixed deposit. That's taxed money. So if I pay tax on it, it comes down to 8% or 7%, depending on what my tax bracket is. But there's also the impact of inflation over the long term, isn't there?
Absolutely, absolutely. Now, for example, if you did a fixed deposit and one of your parents did a fixed deposit 18 years back, just hypothetically taking a number. The 100 rupee invested, let's assume they had 1 lakh rupee of fixed deposit. Every year they renewed the fixed deposit and came to a stage after 18 years, the 100 rupee would have become, or the 1 lakh rupee, like we took as an example, would have become how much? 4 lakh rupees. Your parent wouldn't have actually regretted, because he's seen that 1 lakh rupee has become 4 lakhs. On the contrary, there were only 10 equity mutual funds available back then in 96. How many mutual funds were there? 10. I could have distributed my money 10 rupees each in all the available 10 funds. Do you know what it would be? 1 lakh, which in an FD became 4 lakhs, 1 lakh would have become 28 lakhs. So what did your parent lose out by deciding not to take the risk? 24 lakhs on 1 lakh. And he would not realize because nobody has told him that.
There's a young man in the back who has a question. Go ahead.
Hi, my name is Mohsin and I'm working as a risk analyst from past 2 years. My question is, people have little bit of consciousness. When we invest, suppose I have invested in gold, which does not provide me any tax benefit, right? And there are mutual funds or other market related securities where we can invest and it will give us tax benefit, right? I wanted to know how investing in these funds, does it help in the development of economy? Because as a responsible citizen, I am supposed to pay the tax, right? If I invest in the market for saving my tax liability, does these funds do anything for the development of a country?
It is plenty, though, for the development of the country. Which of you gentlemen wants to take it?
I can take it. See, one is there is a direct benefit. One, there is an indirect benefit. I understood your point that if I invest in equity, after 1 year, it will become completely tax-free. That's a big tax benefit. There is nothing in the country which gets taxed at zero other than agriculture. Okay? And equity is the one other thing. So you invest my money, and if it doubles, quadruples, after greater than 1 year, I don't pay any tax. So if you're not paying tax, but the most important point is there is no direct tax payment. But these are the corporates which contribute to the growth of the economy in itself. They create employment. When they create employment, there is salaries being paid. There are taxes deducted there, right? They actually contribute to a lot of growth of the economy. So there is an indirect benefit to the country of investing in equity. To get the indirect benefit is why that incentive is passed to equity to promote people getting lured by the negligible tax and then coming in, because that's what will help the country.
Actually, the interesting thing to consider also is that all tax benefit or tax deductible investments have a lock-in. So they encourage you, and you're mandated to stay invested in 3 years, 5 years, 10 years, 7 years. That's the way the government uses to raise long-term money. So they can build bridges and infrastructure because they need to have the money for 5 years or 10 years in order to create large infrastructure projects. All right, on that note, we have to take another very quick break. But the quick learning from this for all young investors: start early, sit down and list out all your goals. Short-term goals should go into a debt fund, or if you're not comfortable just yet, start with a recurring deposit. Once you get comfortable putting money aside every month, then move into a debt fund. Anything that you want to invest for the next 5 years or more than that should find its way into equity and tax-saving equity if possible. On that note, we're going to take a quick break. When we come back, we'll talk more about using mutual funds for your long-term investments. Don't go anywhere. Welcome back. You're watching the Swatantra series on ET Now. Thank you for staying with us. We're talking about investment ideas for young people. So if you have a young person at home, make him sit down and watch this show. If not, take down some advice and hand it to him or her. Tell them to start investing as soon as possible. We have a lot of questions from the young people in the studio. Go ahead.
So if we talk about building a retirement corpus, apart from the PPF, what are the other avenues that I can invest in? Safe avenues, I would say.
The biggest mistake to do is to look for risk-free investments for your retirement. There's nothing bigger as a mistake you could do. So don't get carried away with riskless assets. You will not have a very good retirement, because that is the most important goal. Think about it. You work for 30 years, 35 years. You will have to live on your savings for the next 30 years. If you look at a life expectancy of 85. So what you save will have to be used for 30 years. So if you don't create enough money, then you will have to cut down your lifestyle, which nobody wants to do after having put in the years slogging, right? So please don't do this mistake of searching for risk-free assets.
Actually, the other thing you should consider is if you already have a PF deduction from your salary, which is the Provident Fund, you don't need to duplicate that effort and get the public Provident Fund over it. You have to diversify and also get equity. So a mutual fund would be the ideal investment if you already have that deduction. So that deduction is compulsorily happening for you anyways. So you don't have to go and repeat the effort by getting a public Provident Fund over and above that. The other thing I want you to all remember when you're deciding that, okay, this is my financial goal. A financial goal needs to have two things. It has to have a time horizon, and it has to have a money amount attached to it. So, for example, I'm going to buy a house in the future is not a financial goal. I want to go to Brazil in 2 years' time, and it's going to cost me 5 lakh rupees. There's a time and there's a money. That is a financial goal. Then you can work backwards and decide where you want to invest that money and what suits you best. So you have to have both of those things in that statement in order to arrive at a financial goal. And without either one, it will be difficult to choose an investment. We're going to quickly take another question. The gentleman in the back.
Yeah, I'm Devrat Kumar. As you told that it is for the long period, like 25 years or 30 years, but the person who is going to start their career. And is there any way for the person who is going to retire in the next 1 month or next in 1 year? So can he get a benefit from that mutual fund, or he should go for some another option, because it might be he need his money in after 2 or 3 years because he already going to be old. So what he should do?
Mutual fund, not being a product, it's a platform to address everybody's need or every rupee's need. If you have 3 days money where you don't want to take any risk whatsoever, like Karan mentioned, there are something called the liquid funds. Okay, where you put your money today, after 3 days you can take back your money, 5 days later. You don't even have to tell them how many days will you keep it. So if there's a person who's retiring, does mutual fund actually have a solution for him? A big yes. But the mixture of different kinds of funds for a person who's retiring now is going to be very different than a person who's planning a retirement 30 years from now. It's only the mix which will change, but does mutual fund have a solution for a person like that? A very easy solution. Right? So depending on the need of the person. So it can address.
And the person who is retiring, I think, would have some corpus with him. And what mutual fund can provide him is, with that corpus, because he's a retiree, so he would like to have a regular income. So mutual fund has this product called systematic withdrawal plan, wherein he puts that corpus in, he keeps the corpus for 1 year, post that he gets regular income, which is absolutely tax-free after 1 year. So he can decide what regular income he wants after 1 year. Maybe it's 10,000, 20,000, depending upon his needs. That becomes absolutely tax-free after 1 year.
All right, let's take another question.
I just want to ask that is there a correlation between a short-term and long-term financial goal and debt and equity mutual funds? I mean, if I going for a long-term, my plan is for a long-term investment, so whether I should go for equity one or for debt mutual funds. So is there a relation?
Define long-term here.
I mean, suppose retirement planning is there. So whether I should go for equity mutual fund or debt mutual fund?
Yeah, I had mentioned right in the beginning that when you go for retirement planning and you're starting early, there is, first stage is called accumulation stage. So how do you accumulate? And you have better risk profile that time, you can take higher risk. And then that is the time wherein you can get into mutual funds and equities, what Feroz just mentioned, various other products, ETFs, gold and all that. And of course, fixed income. Once you have reached a corpus and you're about to retire, then the time comes for your capital preservation and distribution of that corpus, which is, like again I said, you can invest in your short-term income fund and other products, and then have a systematic withdrawal plan for distribution of these funds.
In effect, there is a strong correlation between what assets you choose and what time frame your goal is. Your goal being short-term, to reiterate, which we would have already discussed, equity portions have to be very small or negligible. If they are long-term goals, then equity portions can actually capture a large portion of that money, because equities will have a huge potential of creating wealth and will mitigate the risk over long terms. So there is a correlation.
When we talk about retirement planning, I think the other three major factors are that when you get into an investment strategy for retirement planning, you need to have a disciplined approach to that, which is you need to quickly start an auto debit in your bank, which goes into this fund, because more money is lying idle, you will tend to spend. Second part is you need not be emotional about your investment account, because there's going to be volatility in the market and you are looking, and the mutual funds are very transparent, they declare NAV on daily basis. You should not get carried away by that, because your long-term goal is more than 5 years, or retirement planning is up to 25, 30 years. So you need not get carried away by that. And third part is you should monitor your portfolio and the risk associated with that portfolio, and once in a while can do the readjustment of your portfolio.
In fact, what a lot of young people complain about is that I don't have any money left at the end of the month to invest, which is a common complaint. The truth is you do. What you need to do, and you can start with 500 rupees a month. That's the minimum investment in a mutual fund. Write down what salary is coming in, what your expenses are. And in that difference, take out a little bit of money every month. Invest it on the 2nd or the 3rd of the month when the salary comes in. And after a point, you will stop feeling the pinch. You won't miss that money. It'll automatically keep going into your investment, and it won't feel like, you know, oh, I've not invested any money, or I have nothing to invest every month. It'll become a disciplined approach. I'm going to take one last question from the gentleman in the back.
Hello, my name is Sarang. I am currently 27 years old, and we are talking about retirements. So what is the ideal corpus which one must target? And what is the financial instrument which one must use? Like we have the NPS, we have the retirement plan. So how to go about it?
So there are two methods. One is using professional management, like you rightly pointed out, using NPS, National Pension Scheme, which has been recently started, and the other is mutual fund. But just to put things in perspective, you know how much would it cost you to hire 50 analysts working for you in a mutual fund? If you have bought 2 mutual funds, you automatically have 50 people working for you. If you're putting 1,000 rupees a month, you will have to spend 200 rupees in the entire year to get these 50 people working for your money. Isn't that a very inexpensive affair? Now you have good professional managers packed in National Pension Scheme, and they are available at 1/10 or 1/20th the cost of a mutual fund. So NPS is a very, very good platform for all the people in the age bracket of 18 to 60, okay, to plan your retirements. It's one of the most inexpensive methods in the country to hire professional managements. Using a mutual fund would cost you 250 rupees for a 1,000 rupee SIP, and to top it all, NPS will cost you 1/10 or 1/20th that. You will pay 10 rupees to get professional management for a year. So NPS is a very good method, and equity is what you need to choose for your retirement plan.
So see, basically NPS has a cap on your equity allocation up to 50%. You can go halfway into equity. If you feel that you want to be more aggressive and go all the way into equity, then a mutual fund would be a better bet for you. If you want 50-50 equity and debt, so like half a fixed deposit, half stocks, then NPS is a good way to go. I'm going to ask, we have one last question. I want to try and fit as many into the show as possible.
My name is Randesh, and I have a simple question here, that investing in India is doing a graduation in this thing. So why it look like so that whenever we are seeing an ad of this mutual fund, anything, so they are showing the benefits and the big time, but at the last they will add certain lagu. So it shows that they are hiding something from the customer or anything. So it is giving some doubt among the investors.
Yeah, I think if you look at the risk elements which are there with mutual funds, so yes, mutual funds are, there is a market risk, there is an interest rate risk, there is a liquidity risk. So all the risks are associated with the fund. But let me assure you, mutual funds are the most well-regulated, in terms of asset class, it's one of the most well-regulated industry. The other element is there is high liquidity if you compare with any other asset class. I mean, if you're not comfortable about the market, or your goals have changed from short term to long term, or vice versa. So you have the flexibility to come out of it any time.
Do we want to take one last question? Yes.
If I want to invest for a period of 5 years, so what will be more preferable here? Investing in equity shares or investing in mutual funds? Because equity will provide me easy liquidity. So which will be more?
I think my suggestion to you would be, if your investment horizon is 5 years, you should look at all the asset classes and do a proper asset allocation based on your risk appetite.
Looking at the contemporary situation of where we stand as an economy, to my mind, a larger skew towards equity would be very strongly advisable. Gold, maybe not from today's perspective. You should not have gold. Only 2 capital markets, equity 75% and 25% debt. For a moderate and a little aggressive investor for 5 years should be good, to my mind.
If you consider a shorter period of time, even shorter than 5 years, suppose 3 years. So what are the, if suppose I set a goal for 3 years, so how should I go about it, investing monthly basis, so that I can achieve it after 3 years? Understanding the economic situation, markets are going good, everything is going good, but you never know what is the risk coming up in front of you after a few years. So how should we go about it?
See, we have, if you are going through SIP, if you walk into any financial advisor's office, he would have an SIP meter with him, which says that after 3 years, what is the amount you're looking at? That's what your question was. So if you say I'm looking at 1 lakh after say 3 years, that SIP meter will calculate that how much investment you need to start doing today on monthly basis, which will lead you to that corpus.
All right, unfortunately, we've completely run out of time on this show, but the conversation can continue in the studio. We have to wrap this up. If you have a question for us, or if you'd like to be part of these shows and join us in the studio and ask your questions, indiainvestkaro.com, that's our website. You can get in touch with the entire team. You'll also find videos of this show on that website. You can also tweet. That's #InvestKaro at ET Now Live. Thank you so much for watching. Gentlemen, thank you for taking our time out and joining us in the studio. Stay with ET Now.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का. Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.